Swayam Prabha. Digital India. Educated India.
Good morning. Welcome to the 15th lecture on economics, management and entrepreneurship. Today, we shall discuss a very interesting topic of how to make financial plans, or rather how to convert annual plans into financial plans, which is basically called the master budget. Basically, a master budget, which is also known as a pro forma statement, it is a formal quantitative expression of management plans. And usually, this quantitative expression is in the form of monetary units. The master budget summarizes the planned activities of all subunits of an organization, such as sales, production, distribution and of course, finance. It quantifies target for sales, purchases, production, net income, cash position and other management objectives. Thus, it is a coordinated set of detailed financial schedules and statements and includes forecasts of sales, expenses, cash receipts, disbursements and balance sheets. Today, we shall take a particular example to tell how actually a master budget is prepared, and that will give enough insights as to how a master budget is actually prepared in practice. Before we do that, we first of all suggest that there can be different forms of budgets depending on the planning horizon time or the time span. It can be a strategic plan which does not have a specific plan period. A strategic plan basically sets long term goals and short term objectives and may not be associated with any financial statements. A long range plan, on the other hand, is usually made for a plan period of 5 to 10 years and is normally coordinated with capital budgets. Capital budgets where large sum of money will be invested for improving the operations of the organization. The master budget, which is the subject for today, is usually made for a plan period of 1 year. Essentially, the first year of a long range plan is the period for which a master budget is prepared. Also, one can make budgets for individual managers for individual tasks that he or she is supposed to carry out. In addition to these budgets, it is also possible to have a rolling budget, where the plan period could be for a 1 year. However, in practice, when one period elapses, 11 months remaining, one more month is added and a budget is updated or freshly prepared or prepared afresh. This is called a rolling budget. Now, there are different components of a master budget. In this particular slide, we show such a budget, such components of a budget for a non-manufacturing unit. In the non-manufacturing unit, first of all, we shall have a sales budget. Depending on the amount to be manufactured, we shall have a purchase budget to purchase the materials and how much to manufacture, the cost of goods sold budget. Once these three are prepared, we also know the expenses to be incurred, and therefore, operating expenses budget can be prepared. Naturally, sales budget is the main input to budget making exercise. That means that sales have to be projected in the future, and on the basis of an estimated sales, one can decide how much materials to buy, how much manufacturing cost to incur, what is the operating expenses. Once we have that, we can make the income statement, and of course, separately, if a company wishes to invest in long term capital investments, then cash will have to be spent on such investments as well as to carry out the operations of the company. So, this part of the budget is concerned with the operations of the company, whereas this part is concerned with the finance of the company. So, cash naturally will require the operations to carry out the operations as well as to make capital investment. So, accordingly, a cash budget can be prepared, and then the balance sheet, budgeted balance sheet can also be prepared. So, this is more or less the components of a master budget in non-manufacturing unit. Of course, in a manufacturing unit, there will be more details such as inventory budget, production budget, direct labor, direct material budget, and so on and so forth. We have not considered overhead expenses budget, and those aspects are not shown in this particular slide. For a manufacturing unit, as I was telling you, in addition to whatever we had for a non-manufacturing unit, here we shall have sales budget. The manufacturing budget itself will have different components, sub-components, production budget, direct material usage and purchase budget, direct labor budget, factory overhead budget, and of course, cost of goods manufactured and cost of goods sold budget, budgeted income statement, cash budget, and budgeted balance sheet. So, these three items are common, sales budget is common, but we have details of the manufacturing budget in the form of production, direct material and purchase, direct labor, factory overhead, and here we have cost of goods manufactured in addition to cost of goods sold. Now, we take up almost a real life problem to illustrate how a master budget is prepared, what are the basic assumptions for preparing a master budget. This will be quite interesting, and it will bring out to open the different assumptions on the basis of which a master budget is prepared. The statement of this master budget background is this: the ABC company is a retailer of a wide variety of household items. So, it is basically a non-manufacturing case. It is trying to develop a budget for the first time. Plan horizon time is, for the sake of simplicity, we have taken 2 months although normally it is 1 year. We have taken just 2 months after the financial year, it is April and May. The closing balance sheet for the fiscal year just ended, that is March 31st, end of March 31st, the balance sheet is available and is given here at the end of March 31st, and we are required to prepare the budgets, the master budget for the months of April and May. Cash is left with current assets, other assets and total assets. Cash 10,000 rupees, accounts receivables 16,000 rupees. Forget about these things, we will discuss in detail the meaning of all these things. Then inventory that is left with the company was 48,000, and insurance for which amount was paid, but has not expired in advance, of which this company has the is considered as an asset because it is an advance payment, is 1,800, totaling 75,800 rupees. The plant assets, or which are also known as fixed assets, are different equipment, fixtures and other things, which comes to 37,000, but depreciation accumulated over the years are subtracted, and that amounts to 12,800 rupees. This is within parenthesis, meaning that it has to be subtracted from 37,000. This is the purchase price minus the accumulated depreciation, gives us the present value of the book value of the plant assets, that comes to 24,200. The total assets of the company is 100,000 rupees. Now, on the liabilities and the owner's equity side, the current liabilities are accounts payable, meaning the amount that is to be paid to the suppliers of materials. It has not been paid. The purchases had been made in the form of credit, some in the form of credit, some may have been made in cash. So, accounts payable is 16,800 rupees as on March 31st, and wages and commissions also have not been paid, some of them, and that amounts to total 4,250. So, together 16,000 and this comes to 21,050 rupees. That is, I think it will be better if we can write this down here, so that this plus this is equal to 21,050 rupees, and the owner's own paid in capital plus other profits that have been accumulated in the past few years amount to 78,950 rupees. Therefore, the total liabilities and owner's equity comes to 100,000. Now, given this information, we have to prepare a budget, the master budget, but the main thing in the master budget is to be able to make a good forecast of sales for various months in the future. We are interested to make forecasts for April and May. However, what are given here are the forecasts for 4 months, or rather 5 months, April, May, June, July, August, and it goes up like this. From 15,000 it goes up to 80,000, but then declines in June, July and August to figures of 60,000, 50,000 and 40,000 rupees worth of sales. In March the sales were 40,000 rupees. So, it is almost a cyclic fluctuation. It has gone up from March to April to May, but then coming down in June, July and August. Of course, as I said, we have to make a budget only for April and May, and that was done for the purpose of simplicity only. The other information that are given are actually the assumptions on the basis of which the budget has to be prepared. The sales manager expects 60% of the sales to be in cash and 40% on credit. So, this had been the experience of the company, that of the total sales 60% is usually in the cash form, but 40% on credit, which are collected in the month following the sales. That means, in the next month this amount is credited. The amount that is sold on credit is actually collected next month. So, this will give us an example, give us an idea as to how to make a cash budget and how to make accounts receivable budget. Now, at the end of any month, the company wants a basic inventory of rupees 20,000 worth of materials plus 80% of the cost of goods sold in the following month. So, a company has to have an inventory policy. How much inventory it would have today to be able to sell this month is very important, and it has a policy that it should have something like a safety stock of rupees 20,000 worth of materials plus the expected sales in the following month and the corresponding cost of goods sold, 80% of that should also be in the inventory. And the cost of goods sold averages 70% of the sales. So, from here one can also estimate the cost of goods sold. Next, about purchases. The purchase terms available to the company are net 30 days. Each month's purchases are paid as follows: 50% during that month and 50% during the next month. Net 30 days means 1 month's requirement is purchased at one time, and for which half the amount is paid in cash, is paid that month, that is in cash, but the other half is on credit. Therefore, the payment is made for that credit purchase in the next month. Wages and commissions are paid semi-monthly, that is within every 15 days, half a month after they are earned, and they are divided into two portions: a fixed wage of rupees 2,500 and a commission equaling 15% of the sales. So, wages and commissions, this is the historical, these are the historical values. Next, in April, a delivery truck will be purchased for rupees 3,000 or hired, you can say, for rupees 3,000. Other monthly expenses are miscellaneous expenditure 5% of sales paid as incurred, meaning in cash; rent 2,000 paid as incurred, meaning in cash, no credit; insurance rupees 200 expiration per month. Recall that there was an unexpired insurance amount, meaning that advance payment was made for insurance. For every month 200 rupees is to be credited to that, and depreciation including truck is rupees 500. The company wants to have a minimum cash balance of rupees 10,000 for liquidity at the end of every month. Money can be borrowed or repaid in multiples of rupees 1,000, and interest rate at which money can be borrowed or repaid is 12% per annum. This set of information is naturally to be collected to be able to proceed. What we are required to do is to prepare the following detailed schedules: cash collections from customers, purchase budget, disbursements from purchases, operating expense budget, disbursements from operating expenses, disbursements for operating expenses, and using the above schedules, prepare the following major statements: budgeted income statement, budgeted income statement for 2 months ending May, and budgeted balance sheet as of May 31. Now, let us proceed with our budget making exercise. First, the sales budget. The basic assumptions of a sales budget is that of the total requirement, total sales, 40% will be on credit and 60% will be in cash form. Now, recall that in March, the month that just ended, 40,000 rupees worth of goods were sold and the forecast sales for April was 50,000 and for May it was 80,000. This was the forecast made. This was the forecast made. Sales in March were rupees 40,000 and sales forecast for April and May were 50 and 80,000 respectively. Now, naturally, whatever was credit sales in March, that was 40% of March's sale, which was 40,000. So, that came to 16,000 and cash sales was 24,000. We require this information because whatever was credit sales in the month of March, after 1 month, this will come in the form of cash. This will be collected back. That is why we had to add this column. For the month of April, 40% of 50,000 is 20,000 and 60% of 50,000 is 30,000. So, this is the expected credit sales and cash sales in April. Similarly, we found out credit and cash sales for May by multiplying 40% of 80,000, 40% with 80,000 giving 32,000 and 60% of 80,000 giving 48,000. So, this is the schedule A and this is basically sales budget. Next, we prepare cash collections. Cash collection is not a budget. Firstly, we are writing only collections, then we will give disbursements, then only the cash budget can be prepared. Now, collection is the cash is collected for 100% of last month's credit sales. That means, March's credit sale was 16,000, that will be collected in the month of April and will be available with the company in April. That is what we have written. So, 16,000 that was due to be obtained from the customers is now available in April. In addition, in April there is a cash sale of 60% that came to 30,000. So, 30,000 will also be collected in April from out of its April sales and this is the credit sale of last month. Together they will give 46,000 cash in April. Similar calculation is done for May, where cash sales of May is 48,000 and in credit sales of April is 20,000 to be collected in the month of May, giving a total of 68,000. So, we can therefore estimate the cash that can be collected in the month of April and in the month of May. Now, go to purchases budget. Now, here you see the how much to buy. How much to buy will depend on what is the desired end inventory that we would like to leave with at the end of this month, how much inventory we would be leaving, how much we started with and what will be our cost of goods sold. So, desired end inventory basically budget amount to be bought or purchased will be equal to the amount of inventory that we will be leaving behind at the end of the month plus the cost of goods that will be sold minus the beginning inventory. Whereas, desired end inventory according to our assumption was that 20,000 rupees worth of goods we should have something like a safety stock plus 80% of COGS in the following month, and COGS is 70% of sales. Now, sales, so we write down the purchase budget now. In the purchase budget, 70% of sales. So, March sales was 40,000, 70% of that is 28,000. April was 50,000, 70% of that is 35,000. May was 80,000, 70% of that is 56,000. That is the COGS. So, now that we know COGS, we can now calculate the desired end inventory. It is equal to 20,000 plus 80% of COGS in the following month. That means, if we are interested for April, the following month COGS is 50,600, 80% of that plus 20,000 would give us the value of desired end inventory in April. So, similar calculations have been done using this particular formula to get the desired end inventory positions for different months. Now, come here, total quantity needed, therefore, is the sum of these two, that is desired end inventory plus COGS, desired inventory plus COGS, that is I am calling it total quantity needed, this addition of these two items. Subtract from that the beginning inventory. From the balance sheet, the inventory position was 42,400 in inventory position was this. So, this I have now subtracted 48,000 was subtracted in April. So, we started with an initial inventory of 48,000, total quantity needed was this plus this. Therefore, the amount to be purchased was 51,800, and similar calculations are made for May. So, basically as we see that these are different assumptions on the basis of which these budgets are prepared. Therefore, it is very important to see whether these assumptions are actually holding in practice. Now that we know the purchases, we can go for disbursements for purchases. The past experience shows that 50% cash payment has to be made for every purchase, but 50% can be made on credit to be sold, to be paid in the next month. Therefore, Therefore, 50% of last month's purchases last month was 33,600 rupees. So, 50% of that comes to 16,800 rupees, for which the payment has to be made, last month's credit sales, and this month's credit purchases, and this month's purchases 50% of that is cash sales, cash purchases, and that was 51,800. 50% of that is cash purchase, that comes to 25,900. Therefore, the total cash payment or disbursement towards purchase of items last month as well as this month is 42,700. By this amount, the cash position comes down. Cash has to be paid for purchases of last month's credit sale and this month's cash sale. And similarly, also one can estimate the cash disbursements for May. Now come to operating expense budget. The assumptions are here, written down here. Wages 2500. So, wages 2500 here appears for March, April and May without any problem straight away. Commissions 15% of sales. So, commissions it was 40,000 in March, so 15% of March sales comes to 6,000. Here it was 50,000. So, 15% of 50,000 is 7,500. 15% of 80,000 is 12,000. So, commissions can also be estimated following this. Commissions 15% of sales. Miscellaneous expense is 5% of sales. So, 5% of we are interested in wages and commissions total comes to, therefore, addition of these two columns, these two rows. So, 2 plus 12 14,500, 2,500 plus 7,500 10,000 etcetera. Miscellaneous expenses are 5% of sales. So, 50,000 into 5% is 2,500, 80,000 into 5% is 4,000. Rent is constant at 2,000. Insurance is 2,000 and depreciation is 500. So, this is very straightforward. Total operating expenses, therefore, in April we are interested for April it is 15,200 and for May it is 21,000 rupees. Now, we have to make payment. For preparing cash budget, we have to know how much we have to disburse on account of operating expense. Here the assumption is that wages and commissions are paid in this manner, 50% of the last month's wages and commissions and 50% of this month's wages and commissions are paid in the current month. So, accordingly 50% of wages and commissions are calculated here, but the miscellaneous expenses and rent are also put here, which was for April 2,500 and 2,000, 2,500 and 2,000 they are put there. Insurance and depreciation, they are not coming in this particular thing because insurance have already been paid for, therefore, no cash disbursement is taking place there, and depreciation we shall study later, no amount actually is paid. It is a non-cash concept and it involves no cash disbursement. Therefore, insurance and depreciation do not come in this particular schedule. So, in April they amount to 13,750 and in May it is 18,250. So, these are the operating expenses, how they are disbursed in the form of cash, basically cash disbursements. Now that we know the cash that we have received and the cash that we have disbursed, we can now prepare a cash budget. First of all, we have to understand the beginning cash balance. Beginning cash balance in April is the end of cash balance in March. Cash balance in March, if you look at the balance sheet that was given earlier in the question, cash was 10,000 rupees. Thus, that was the end of March cash position. Therefore, the initial cash position in April is 10,000 rupees. That is the cash balance, and after the budget, whatever cash balance you will be left with at the end of April will be the initial cash balance in the beginning of May. So, first of all, this column has to be items values have to be found out and totaled, and then this will come here, and similar thing has to be done for May. Now, the minimum cash balance desired is 10,000 rupees, that is given in the question. The available cash balance is therefore this minus this, which is 0. Now, look at the cash receipts and disbursements. In April, from the customers, schedule B gives 46,000. Let us see schedule B. Schedule B gives a total collection of cash in April as 46,000. That is what it has come here. Payment for goods, schedule D will give. We can similarly go to schedule D and find out. This will be, this is 42,700. This is a collection, therefore, it is 46,000, but payment is a negative value. So, it is put in parenthesis. Payment for operating expenses, schedule F 13,750, that is just what we have seen here, 13,750. So, that is written down here. Purchases of a new fixture is given as 3,000 rupees. Net cash receipts and disbursements will be 46 minus this, minus this, minus this, and that comes to minus 13,450. So, it is negative balance, and we are available cash balance is 0. Therefore, 0 minus this is minus this. So, it is a deficiency of cash. This is x, this is y, therefore, x plus y is this. Now, look at financing. The company can borrow. Now, it can borrow in multiples of 1,000 rupees. So, if it is requires 13,450, it can borrow 14,000, and this has to do at the beginning of the month of April, and repayment at the end of the month with an interest rate of 12%. Now, it is the payment is made at a rate of 1,000 rupees, 14,000 and interest. So, at this time it is not making any payment, and therefore, the total cash balance becomes 13,000, that is negative item. Total cash increase from financing is 14,000, and that leaves a beginning balance of 10,000, and y is negative 13,450, and z, the amount that it is borrowing as 14,000, this gives us a value of 10,550. So, ending cash balance in April will be 10,550, but it has to borrow an amount of 14,000 rupees. Interest and repayments will be done in the next month. So, they are not coming in the month of April. Now, this amount becomes the initial value, initial cash balance in the month of May, and similar calculations are made here, only the repayment is made at the end of the month. It is 1,000 rupees and 12% is 20 rupees. So, that comes to 1020, and the ending cash balance becomes once again beginning balance plus y plus z gives us 10,980. So, this is how a cash budget is prepared. Now that we have made various statements or various budgets, we can now make budgeted income statement for 2 months ending May 31. Now, here are the schedules from where these data are collected. Sales is now already 50 plus 80, total of April and May becomes 130,000. Total of COGS can be similarly calculated as 91,000. Gross margin is therefore this minus this, which is 39,000 rupees. Operating expenses, these are all sum of April and May. For example, rent is 2000 plus 2000 is 4000, insurance 200 plus 200 is 400, depreciation 500 plus 500 is 1000. So, these are all sum of total of expenses, operating expenses in the months of April and May. All of them come together as 36,400. So, subtracting operating expenses from gross margin leave us with an income of 2,600. The interest expense has to be subtracted, leaving a net income of 2,580 rupees. Various schedules from where these values are actually collected are given here. Now, we can make the balance sheet for May, and you can get it from different schedules as well. Cash budget, it gives 10,980 rupees. Already we have prepared the cash budget for May. For example, we can see the cash budget for May is here, ending cash balance. So, that is what we are writing there, 10,980 rupees. Accounts receivables, this is the assumption in the question formulation, is that net of 40% of May sales. May sale is 80,000, 40% of that is 32,000. So, we are assuming that this amount will be on credit sales and they will be accounts receivables in the next month. Inventory, according to our assumption, 20,000 rupees FT stock plus 80% of COGS. So, June sales, COGS in May is 70% of June sales, COGS of June is 70% of June sales. June sales is 60,000, 70% of that is COGS of June sales, multiplied by 0.8 plus 20,000 brings it to 53,600. Unexpired insurance, for 2 months 400 rupees were paid, 200 rupees for every month, April and May. Total unexpired insurance was 1800, minus 400 is 1400. Therefore, the current assets total equals 97,980 rupees. Plant assets will be initial purchase price 37,000 that appeared in the March balance sheet, plus 3,000 rupees worth of goods were purchased, making it 40,000, but then accumulated depreciation will be additionally 1,000 rupees, because 500 rupees every month, for 2 months it is 1,000 rupees, totaling 13,800. So, the plant assets and net becomes 26,200. The total assets become this plus this, 124,180 rupees. Now, we can make the liabilities and the owner's equity. Accounts payable, according to the assumption, it is 50% of May purchases of 44,800, schedule C is giving, that comes to 22,400. Accrued wages and commissions payable is 50% of the amount that is given in schedule E, that comes to 7,250, and these two add up to 29,650. Owner's equity is the previous previous equity plus the net income in the 2 months, March and April, that comes to 2580 rupees, and that therefore, the owner's equity has increased from 78,950 given in March end balance sheet, and now it is 81,530. The total liabilities and owner's equity therefore is the sum of the two, that is 111,180 rupees. This equals, there is a difference, the total assets and the total liabilities, they do not match. So, there is some errors, estimation errors, that the accountants actually take into consideration and make corresponding changes. So, friends, we have gone through a particular example to illustrate how a master budget is prepared. First of all, let us understand that the basic input to preparation of a master budget is the forecast of sales in the next few years. If the sales can be projected with great amount of accuracy, then the budget is likely to be accurately prepared. Also important is the set of assumptions that are to be prepared or that are to be followed for preparing each item in a master budget. And these assumptions are not hypothetical, they are based on practical past experience. For example, that of the sales 40% will be cash and 60% will be on credit is basically the experience of the company in the past. Similarly, that 50% purchases will be on cash and 50% purchases will be on credit is also based on past experience. Similarly, cost of goods sold, that it is a function of the sales, 70% of the sales, and this also is based on past experience. In addition, inventory policies, how much inventory one will keep. In this particular case, we had taken a safety inventory of 20,000 plus 80% of COGS of next month's sale. This is a policy that the company had been following in the past. Naturally, this has to be now put in our master's budget. Unless these assumptions are validated, accepted and actually used by the managers in practice, budgets will stand nowhere. Therefore, in order to prepare budgets, financial managers need to know from production managers, from inventory control managers, from purchase department and from others the assumptions or the policies that they had been following. And once these policies are put in mathematical terms, it is easy to prepare a budget. And a budget is basically an implementation, a financial implementation of the actual plan in future. Therefore, it provides a guideline, and in our next lecture we shall see how these guidelines are actually maintained, and if there are variations from these guidelines, then who one should account for, who should be responsible for these variances. Therefore, master budgets basically prepares the set goals in financial terms, translates management policies and plans into financial figures or financial goals, and it is expected that these goals will be maintained. If there are variations, then we should see or we should find out the amount of variations and why such variations occur. This we shall discuss in our next lecture. Thank you.